Greetings, and thank you for joining us today for our annual year-end Planning Opportunities webinar. This is Tim Wyman, Managing Partner here at the Center, and on behalf of our entire team, we appreciate your continued confidence and trust as we strive to improve lives through financial planning done right. You know, as a comprehensive financial planning firm dating back to 1985, we certainly understand and appreciate that every financial decision and strategy has an income tax component. You might even call us tax nerds, and many of the opportunities discussed during this webinar will be tax related. Now, we don't let the tax tail wag the dog, but we do work extremely hard to provide education and guidance to help you, our clients, maximize and in many cases reduce your overall tax liability. It's my pleasure to briefly introduce our presenters today, Nick Deffenthaler and Josh Bytel. Nick is a CFP certified financial planner practitioner, and in addition to being a lead planner working with clients, he's also our director of financial planning. Josh is a client service associate within our financial planning department and is also a key member of our team, both gathering income tax returns as well as providing analysis. Together, they're going to address several planning strategies for your consideration before year end, given the new tax laws. Additionally, they're going to review strategies that you and your advisors will want to make sure that you have your radar as we head into 2019. So again, thank you for spending some time with us. And now here's Nick to get us started.
Thanks so much, Tim. I appreciate the great introduction, and I would have to agree. We are certainly a few tax nerds all in the room right now, so really excited to go through this annual webinar that we do for clients and strategic partners. There's a lot of things that certainly you want to keep on the radar as we get closer and closer to the end of the year, especially with tax law change. So as Tim mentioned, thought it would be a great opportunity to do an overview of some of the changes that have gone into place as of 2018 with the Tax Cuts and Jobs Act. So we'll dive right in. I thought this was a pretty cool chart to take a look and visual to highlight all the different years and time frames that we have seen as a country significant tax reform. And you'll notice if you take a look, even from 1954 to 1986, that was a period of time of 32 years. And then if you look from 1913 to 1954, that time frame between tax reform, that was 41 years. Now, arguably, the tax reform that we saw in 2001, while there were certainly some changes, it wasn't the significant overhaul that we saw from 1986 to 2017, which happens to be 31 years time frame. So you're seeing a common theme here, I guess, is what I'm trying to communicate. Roughly every 3 to 4 decades as a country, we like to have a pretty significant tax reform. So that's certainly what we saw at the end of 2017. Last year, when we hosted this webinar, there were several different proposals on the table. At one point, there was talk of reducing the amount of tax brackets down to 3 or 4, depending on whose version you were looking at, Republican or Democrats. So things did certainly change quite a bit, and excited to go over those changes as a refresher for everyone on the call. It is important to note that the tax law change that we saw at the end of 2017 that is now going into effect for 18 actually sunsets at the end of 2025. Now, certainly these could be made permanent. They could potentially go away depending on our political landscape, but it is important to know that the way the law is written, it is set to sunset in 2025, at the end of 2025. So that's an important point that we'll circle back to in a little bit here. So let's take a look at the 2018 tax brackets. There were certainly some pretty significant updates compared to 2017. So there, as I mentioned, at one point, depending on which proposal you were looking at, there was a lot of talk of reducing the amount of brackets. Well, that didn't happen. We still have the same number of brackets. So arguably the whole conversation of simplifying the tax code, at least as it relates to the amount of marginal brackets that we have, that didn't actually happen. So let's just go through each bracket and I can explain how things have changed compared to last year. So the 10% bracket, if you're married filing jointly, it's the first $19,000 or so of income that you're receiving. That's taxed at 10%. That bracket did not change. In 2017, it was 10%. The 12% bracket, as it stands now, used to be the 15%. The 22% was the 25% last year. The 24% was the 28%. The 32% used to be the 33%. The 35% was actually a bracket that was in place last year. However, some of the income parameters when you're comparing married filing jointly and single certainly expanded. And then finally, to wrap up, the 37% bracket, the top end in our tax code for personal tax rates used to be 39.6 if we compare that to 2017. So there certainly have been some pretty significant adjustments as to what rates people are being taxed at. And there's also been some pretty wide, some widening, I guess is the best way to describe it, of the actual income parameters in most of these brackets that you're actually seeing people being taxed at. So very important to have a conversation or at least review your tax situation in 2017, looking forward into 18 to identify some opportunities that could make sense to take advantage of, which is certainly some things that we're going to go over today as we progress on the call. So in addition to tax rate changes, there were some pretty hefty updates as it relates to certain areas of the tax code with exemptions and deductions and all that good stuff. So thought it would be a good opportunity to go through those and just highlight some of the key changes. So moving forward in 2018, the standard deduction has almost doubled. Prior to the Tax Cuts and Job Act going into place late last year, roughly 75% of Americans took the standard deduction. That basically meant that if those folks added up things like their charitable contributions, state and local income tax deduction, mortgage interest, all that sort of stuff, and let's say you were married and the standard deduction was roughly $12,400. If those itemized deductions that I just referenced did not exceed that $12,400, you took the standard deduction. So 75% of Americans actually did that. Now that the standard deduction has almost doubled in size, it's estimated that just over 90% of Americans will take the standard deduction. So because of that, some planning opportunities that we'll touch on in a few minutes as it relates to charitable contributions and certain other areas really become more of a focus and something that you want to be cognizant of, especially with the standard deduction doubling in size. Elimination of personal exemption. So if you can think back to it's on the top part of the second page of the tax return, it highlights how many folks essentially are in your household. You basically used to get a deduction, a $4,000 deduction roughly for each living, breathing human inside your house that you were caring for. So if you had a family of four, $4,000 each, $16,000 deductions that you were able to write off. Those have completely been eliminated. Now, I would say the majority of the returns that I have reviewed, between the reduction in marginal tax rates and because that standard deduction has gone up so much, in many, many cases, those two things make up for the elimination of personal exemptions. But as with any law, some people are winners, some people are losers as it relates to how these exemptions are affecting your bottom line. Another biggie was the expansion of the child tax credit. So if you have a child under the age of 17 in your household, you used to be able to claim a $1,000 credit. And so a tax credit, just spend a few seconds here describing the difference between a credit and a deduction. A credit almost every single time is going to be more powerful than a tax deduction. A tax credit is a true dollar for dollar reduction in tax. A tax deduction isn't going to give you quite as much bang for the buck, so to speak. Another important component of this tax credit was previously the income parameters that you would be phased out of actually being able to utilize this credit were fairly low. So for married folks, you basically could not use that full credit and you were completely phased out once your income started to get right around $110,000, $120,000 of adjusted gross income. $75,000 for single filers. So, some folks were obviously able to use it, but many filers were not able to take advantage of that. Moving forward into 2018, the income parameters of who can actually use this has dramatically expanded. So as long as your income as a married filer is under $400,000, you can use it. If you have income under $200,000 and you're single, you can use this credit. In addition to the income parameters expanding, the credit doubled in size. So it's now $2,000 instead of $1,000. The cap on state and local income tax, or the SALT deduction. This has been probably, if I had to share my opinion, one of the most controversial aspects of the tax law change, especially if you ask people who live in New York or California with very high state income taxes. Basically, to bottom line it, if your state and local income taxes, including your property tax and what you pay to your state and local authorities for your earned income, exceeds 10 grand, you can't deduct anything above and beyond that. That's what you're capped at. This, and with most deductions and income phase outs and that sort of thing, usually the cap for folks who are married is double than the folks who are single. This is not the case. It does not matter if you're married or if you're single. Your cap on state and local income tax, and this includes property tax, is at 10 grand. So this has been a pretty highly debated topic, something that I think we'll continue to hear more of. Who knows if this could actually change, but I think if anything does get adjusted, it could potentially be this aspect of the new law. Elimination of miscellaneous itemized deductions. So previously, if you had items such as moving costs, unreimbursed business expenses, professional fees, etc., if those exceeded about 2% of your adjusted gross income, anything beyond that 2% level, you could potentially deduct. Those have completely gone away. Estate tax exemption has more than doubled. So previously, back in 2017, the estate tax exemption for individuals was just over $5 million, just over $11 million if you were married. That has obviously gone up quite a bit. I did a little bit of research and thought it was interesting. In 2016, it was estimated that only 5,400 households were subject to the estate tax in the entire country. So that was obviously before this change went into place. So I would suspect even fewer folks or couples or families would be subject to this tax moving forward. But if you are in an estate tax situation, this is certainly something that that you're happy with, I'm sure. And to wrap up, in addition to individual tax law changing, business and corporate rates have also been adjusted. So moving forward into 2018 and beyond, corporate tax rates have reduced from 35% to 21%. We could probably spend an hour talking about the business aspect of the tax law reform, but I'll keep it pretty brief here. There have also been some adjustments to businesses who are set up as pass-through entities, such as S corporations, LLCs, sole props, that sort of thing. So you want to be cognizant of the type of business entity that makes the most sense, because prior to this law, one entity could have made more sense to take advantage of or have your business be structured in. That could potentially have changed given the tax law reform. So if you haven't talked to your accountant or your attorney regarding this matter and you're a small business owner, I would certainly encourage you to do so here before the end of the year. So that was a lot of information. I feel like I've dominated the conversation a bit. So at this point, I'm going to hand it off to my colleague, Josh. And he's going to talk to us a little bit about an area that has been quite confusing for many folks and many clients, and that's charitable contributions. So with that, I'll hand it off to Josh, and he can take it from there.
Yeah, thanks, Nick. I do want to address a little bit of the misunderstandings that we've been hearing, especially with a few of our clients, of course. Charitable gifts are still deductible. We just had to be a bit more creative on how we do them in order to see that economic benefit, but they absolutely are still deductible. That hasn't changed. I know that one of our favorite ways to do these, and one of the most common charitable gifting strategies that we've been using, especially under the new tax law, is what's called a qualified charitable distribution, otherwise known as a QCD. We do use a lot of acronyms here, so that's just one of the many that I'll bring up today. Now, these have become much more popular now that the standard deduction has almost doubled, as Nick touched on earlier. And in order for these to work, there's a few things we have to know. Not only must you, of course, be charitably inclined, you must also be above the age of 70 and a half, which is obviously the age at which you are required to take distributions from retirement plans. These type of distributions only work from IRA accounts, so they're not permitted within employer plans like 401ks or 403bs and things like that. So important to know that they only work from IRA accounts. And funds must go directly to a charity. So essentially you're writing a check that goes directly from your IRA to a qualified 501c3 charity.
So Josh, can I ask you a real quick question regarding that? If a client wants to send money directly from the IRA to their bank account and then make the gift from the bank account to the charity, is that something that they can do, or should we stay away from that? Can you speak to that?
Sure. Yeah, that's a great question. In the eyes of the IRS, that will be treated actually as a taxable distribution of your IRA. So if it goes to your bank account first and then to a charity, that would be gifting in the same way as if you just donated cash or a check. It doesn't matter where it came from. So in this case, you would have to write the check directly from the IRA, and it essentially will reduce your adjusted gross income, assuming that you're taking that standard deduction as most Americans do, like you touched on. This can make a lot of sense. The other thing to be aware of is the donation can't exceed $100,000. That's the last caveat. But if you meet all these parameters, I know that we feel strongly that this is the most efficient way to gift, especially under the new tax laws. Now, another popular charitable donation strategy that we like a lot, especially, even before the new tax laws, but of course even more now, is called the Donor Advised Fund, or DAF. Again, another acronym. So basically how these work is you, a charitably inclined person, of course, can donate up to any amount of cash, property, or securities, ideally appreciated stocks, but I'll touch on that in a bit, to a fund that's set up by your advisor for the benefit of numerous charities of your choice. You'll realize a tax benefit as soon as you donate to these funds, or to this fund, and then the donations then get the benefit of the market, so they can grow within there, and then grants are made to charities of your choice at your convenience over time. So we've seen these most effectively used as lumpy or bundled gifts. So let's pretend that you normally take the standard deduction. You could consider donating multiple years worth of gifts in one single year, and then itemizing for that current year, assuming that your gifts and other write-offs exceed the standard deduction amount.
So that's the key point, I think, and where we really focus in on is ensuring that the amount that you're giving more than exceeds that standard deduction. Is that a fair statement?
Yeah, of course. And then it is important to know that this doesn't really make a difference to charities, because you can still grant these funds to them for subsequent years as you see fit. You really get to control when and how these gifts are made, but you're getting that tax benefit all at once. And as I mentioned earlier, if you use appreciated stocks, you get what we like to refer to as a double tax benefit. And what I mean by that is you can avoid paying capital gains on these appreciated stocks, as well as receiving that income tax deduction for the donation. And I know I'll speak for myself and for many of our clients when I say we obviously don't give to charity solely for the tax benefit, but the more efficiently that we can give and the less we're obligated to pay Uncle Sam, the more that is available to actually give to things that we care about. And that is really what we're trying to accomplish here. So with that, I'm going to hand it back off to Nick to talk about everybody's favorite topic, healthcare.
Oh, yes. The healthcare conversation that all of us love, but it's an extremely important topic as it relates to your overall financial game plan. Within the last couple weeks, actually, the new Medicare premium brackets, if you will, that we've shown on the screen here have been released. The Part B premium for most Americans only went up $1.50 this year. So that's not too bad of an increase. So if we're looking at that very top line for folks who are filing single and have $85,000 or less or of modified adjusted gross income, or $170,000 or less if you're married, That premium has only gone up by $1.50. It's now at $135.50 as opposed to $134 as it was in 2017. Open enrollment recently started. So from October 15th until December 7th, you have open enrollment period. Please keep in mind that we have some fantastic resources as it relates to Medicare. Medicare is a topic that is always changing. There's so many nuances within your supplemental plans, and changes occur all the time within the plan. So we have partnered with several fantastic resources that you can utilize as clients. We have recently done a webinar with one of our strategic partners, Health Plan One, or HP1. Callie Hassinger in our financial planning department co-hosted that webinar, so feel free to check that one out. Also, be sure to check out our resources page. There's an FAQ section on Medicare where it's going to give you a little bit more detail, answer some of the most common questions that folks have as it relates to Medicare. So if you are a client of the center or even a strategic partner and you would like more information, let us know. Talk to your advisor, reach out to Josh or I. I always recommend to the clients that I work with, whether it's the first year that you're turning 65 and this is a whole new ball game and you're a little confused as it relates to Medicare coverage, it 100% will make sense for you to reach out to one of the partners that we have as a resource for our clients, such as Health Plan One. But that doesn't stop there. I recommend that each and every year you reach out to these folks just to ensure that you're obtaining the best coverage that you possibly can given your own unique situation. So I'm a little bit jealous that Josh gets to talk about health savings accounts. As I mentioned, we are some tax planning nerds, but I'm going to hand it back to him, and he's going to talk through HSAs and how they can also be an effective planning tool for your situation.
All right, I'm going to throw another acronym out there for you guys, so I hope you're ready. Health savings accounts, or HSAs, they're a popular tool for tax savings. I know we love them. Nick said he's jealous that I get to talk about them because we do love them. As you'll see, they're only getting more popular. Funds in these accounts have more than doubled since 2014. And it's important to know that you can only use these accounts in conjunction with the high deductible health plan. So if you are fortunate enough to be able to utilize one of these, understand that contribution levels have increased. For a single person, they are limited to about $3,450, and for families, that's doubled to $6,900. So that's as much as you can contribute in any year. The major and main and our favorite benefit of these accounts is the triple tax advantage, or a triple tax savings, if you will. And what do we mean by that? So basically that means that you can write off your contributions, you can experience the tax-deferred growth within the account, and then you will also get tax-free distributions if you use them for qualified medical expenses. And I think these are the only accounts that offer that kind of triple tax savings.
Mm-hmm. Absolutely. Maybe Josh, this might be a good opportunity to share with clients and folks on the call some of the planning opportunities that we have recommended in the past as it relates to HSAs and actually deferring funds within the account, that sort of thing. Could you touch on that for a minute?
Yeah, I know. A lot of times what we like to do with clients is we like to see them build up a nice pot of money within these HSAs, and then ultimately sometimes not even use them until retirement time. Sometimes you can bridge that. Let's say you retire early before Medicare age, and that this account can provide a nice bridge until you hit Medicare to really take care of medical expenses in that time. I know that's one way that we like to use these with clients. So I mentioned that that distributions are tax-free if you use them for qualified medical expenses, and that even includes paying premiums such as Medicare and long-term care. With HSA funds, you can no longer contribute to the account after age 65. However, you can still use them very effectively after that time. It is important to know that if you do not use these funds for those medically related items that we spoke about, you'll pay a 20% penalty on top of taxes. And that did go up. It did used to be 10%, but it's at 20% now, which is a pretty hefty penalty. However, if you are over age 65, you can avoid that 20% penalty. So if you use them for non-medically related items, you'll just pay taxes on them similar to an IRA, I suppose.
So in theory, I mean, if you have access to an HSA and you have the cash flow to completely maximize one of these and essentially just pay the healthcare expenses that you have come up out of pocket and not use the assets within the HSA, this could be a tremendous additional tool that could basically function as another IRA once you turn 65, whether you use the funds with or on, I should say, on medical expenses or not, correct?
Right, yeah, very well put. And Nick, I know you're very jealous I got to go over that, but I think you're more than happy to talk about your favorite thing in the world, Roth conversions. So why don't you tell us a little bit about how you work with clients in this area?
Sure. Especially given, as Josh mentioned, I'm a huge fan of at least considering or evaluating Roth IRA conversions for clients. It just has gotten even more and more important, in my opinion, given the tax law change. So I thought it would make sense just to go over a few aspects of Roth IRAs and Roth conversions, how they function, this just to set the foundation so we can go over some more nitty-gritty detail here in a few minutes. Anytime that you're pulling money out of a traditional pre-tax IRA, 401k, 403b, you name the account, you are going to pay tax. Whether you use that money to buy a new car or to actually pick it up and drop it into a Roth IRA through a conversion, those dollars that you pull out are included in your taxable income for the year. There's no way around that. So because those funds are taxable, it's very important to know what bracket that you're going to be in, how that is going to impact your situation, and determine if it could make sense maybe to push money out intentionally out of a pre-tax retirement account and flip it to the Roth IRA. Roth IRAs, as a refresher, grow tax deferred, just like a traditional IRA or a traditional 401k. The difference is that you're foregoing the tax treatment, so that way you don't pay a dime in tax on what you contributed or any of the earnings associated with those contributions when you ultimately pull the money out. So on client net worth statements, we literally earmark these or classify these accounts as tax exempt. As long as you wait, in most cases, until 59 and a half, you're not going to pay a dime in tax on any sort of distributions with the Roth IRAs. So conversions have become even more compelling with rates going down. If you recall, I mentioned that these tax rates, unless made permanent, which could feasibly happen, are set to sunset at the end of 2025. So if you are in and you know that you're going to constantly be in either the 12% or 22% bracket in particular for the majority of your lifetime, if you think your income is going to be in those parameters, it could make a lot of sense to consider taking advantage of a conversion. The way I like to frame it, even if tax rates stay the same as they are right now, it's heads you win, tails you break even, because the break even is they stay the same. The win is that they go back to how they were. And in this one bracket, you were used to be paying 15%. Now you're paying 12%. And if you're doing up to the 22% bracket and fully maximizing that income parameter, it's taxed at 22% instead of 25%. So these are things, and this is why Josh and I love taxes so much, because these are things that we can have control over. We can't necessarily control what the market is doing or the fact that there's upcoming midterm elections, that sort of thing. There's nothing we can do with market volatility. We can't control that. What we can control, however, is ultimately how we recreate a retirement income paycheck and taking advantage of certain times in your life in retirement that make the case to be extremely tax efficient. So I mentioned these gap years. In many circumstances, clients who retire, let's say in their early 60s, they don't plan on turning on Social Security until close to age 70 when it's fully maximized. We have to think as well, Josh touched on it with qualified charitable distributions. At age 70 and a half, you have to start taking out distributions from your IRA. For many of our clients, they have significant assets within those pre-tax retirement accounts. So if you are not proactive during what we would consider these gap years of not having a lot of forced income coming towards you in the form of RMDs, the required minimum distributions, or if you're delaying Social Security, it makes a lot of sense to consider doing either Roth IRA conversions or using your pre-tax retirement assets to live on for your spending needs. Because if you just let these accounts grow and grow and grow and accumulate, they feasibly could double in a matter of 8 to 10 years. Obviously, we don't have a crystal ball and know what the market's going to do, but compounding growth is a pretty incredible thing. And so it doesn't take long for assets to grow if we have a reasonable rate of return. So if that occurs and you just don't touch these accounts for a decade, when you are forced to take distributions upon age 70 and a half, your RMD could be quite large, and that could potentially push you into a higher tax bracket. Required minimum distributions do not exist as it stands right now in Roth IRAs. So if we're moving money from a traditional IRA to a Roth IRA in the form of a conversion, we could let those dollars grow and grow and grow and accrue for decades. They're an excellent estate planning tool as well. I have several clients who don't ever plan on even touching these Roth IRAs. So they have earmarked them to ultimately have those passed on to their grandchildren. Because even when those grandchildren inherit these assets, they're not going to pay a dime in tax. So that could be a consideration as well into your overall financial game plan. As we wrap up on this topic, I mentioned the very large RMDs and the effect that deferring large pre-tax retirement accounts like a 401k or an IRA can have if you don't gradually take money out of those accounts. I had a couple situations lately where clients where we crunched the numbers, and if we don't touch the pre-tax retirement accounts or 401ks, IRAs, we let those grow for a decade and we don't touch them or distribute them, the IRAs feasibly could grow to a point where it's going to throw off their Medicare premiums. We looked at that slide a couple minutes ago and we saw, if your income is under 170, if you're married, under 85, if you're single, well, based on where their RMDs would be and where their Social Security would be, they would be over that threshold. However, if we're proactive and we continually gradually draw down those IRA assets, that's going to reduce their future RMDs, which have an impact on those Medicare premiums. So all of these things, and I'm probably getting into the weeds a little bit too much, but all of these things have a domino effect. So you want to be cognizant of these tax ramifications. And if we can be proactive now during what we would consider the gap years of retirement, especially during a time frame where we have historically low income tax rates, we certainly want to at least consider it. And finally, I'm a huge fan of having flexibility, realistically in any aspect of life. We always talk about diversifying the overall allocation in your portfolio as it relates to investments. Doing this and being proactive and doing conversions over time, if the situation is right, helps diversify the tax treatment of your accounts, which really can give you a whole lot of flexibility down the line in retirement when you're ultimately trying to determine the best way to create that retirement income paycheck. So next, Josh is going to talk to us about an area. I know you spend a lot of time, Josh, on assisting clients with open enrollment and helping them guiding them, I should say, in determining should it make sense to do a Roth IRA, or I should say a Roth 401k, traditional 401k. Can you speak to us a little bit more about that?
Yeah. So you'll see in the table here, retirement plan contributions rose slightly for 2018. And those are the levels at which you can defer into these accounts. The data for 2019 is not released quite yet, but I think we can expect, just like in years past, maybe a $500 raise that the IRS will have or will allow us in these accounts. But as Nick touched on, I think an important distinction within employer retirement plans that can sometimes get overlooked is the difference between a traditional 401k or a Roth 401k. I'm assuming that plans allow for these different components, but I think most do. I know we touched on this already, but Roth contributions don't receive a tax deduction, whereas traditional contributions do. However, distributions from Roth accounts are tax-free, while distributions while in retirement from traditional accounts are subject to income tax. So I suppose that begs the question, which one should you choose? Now, like I said, assuming your employer offers both options, you kind of have to ask yourself, will I be in a higher or lower tax bracket when I intend to use these funds than I am right now? So basically you're asking yourself, when is the best time to pay taxes on these contributions? And I know with our clients, I like to work with a lot of the younger clients here, and I know that we like to recommend using the Roth feature, at least for these type of clients, because generally speaking, they're in a lower tax bracket right now than they'll feasibly be in 10 to 15 years. So we don't think there's a better time than now to build up that nice, tax exempt bucket of money like Nick spoke to earlier, given all the flexibility that allows you while in retirement.
So sometimes, if I'm hearing you correctly, Josh, and just let me know if this is a fair statement or not, it could make sense to forego that tax treatment, or I should say that tax benefit that you normally would see in the traditional IRA to the Roth. But a lot of it has to do with the bracket that you expect to be in the future. Is that fair?
Yeah, exactly. You ideally you forego that tax treatment and pay taxes right now, say when you're in a lower bracket. And then, later when you're in retirement, you expect to be maybe in a higher bracket. And when you're withdrawing that money, taxes have already been paid on it at a lower bracket. So you win in that regard.
It gives even more flexibility.
Exactly.
Kind of to piggyback off of the conversion slide that I went over a few minutes ago, having these different buckets to pull from is huge when you're no longer working. Gives you a lot more flexibility to recreate that retirement income paycheck.
Yeah, exactly. So that'll bring us to some investing. Nick, why don't you touch on this?
Will do. So one of the key areas, and I'll talk about the tax implications in a minute for evaluating your portfolio, but I wanted to make sure that I at least mention and recommend to everyone on the call, now is a fantastic time, especially with some volatility in the market lately. Is the risk profile or the overall allocation, how much do you have in stocks and bonds, and is it diversified? Fantastic time of year to evaluate that. I can't tell you how many folks that we meet with who they share that, we're conservative in nature. We don't want to take a lot of risk. And then once we actually take a look under the hood and see how their 401k is invested or their IRAs, et cetera, come to find out they're 85 or 90% stock. And sometimes you just don't realize it. I mean, we've had a very strong equity markets over the last, close to a decade now. And if you haven't made a whole lot of adjustments, chances are that equity component has gone up quite a bit compared to the bond side of the overall allocation. So really strongly recommend that at least once a year you are reviewing that allocation and the overall risk parameters make the most sense for your situation, especially given your ability to tolerate risk and your overall time frame that you have until retirement. So how are a couple different ways that we could help manage the tax bite, so to speak, on investing? There's been some interesting studies done by Morningstar, which is a very large investment company that helps evaluate mutual funds, stocks, et cetera, that has taken a close look to see how much in total return do investors typically lose or miss out on because they're not as tax efficient as they could be with the overall investments that they hold. So if we take a look at the one chart right down in the middle, the 253 BPS that you see there, we love acronyms, as Josh mentioned. That stands for basis points. To turn that into an easier way to read it, that's essentially 2.53% that investors have lost during the time frame of 1996 to 2000 by not being as tax efficient as they could with their overall investments. Now, this is a difficult thing because we can't measure this on your performance report here at Raymond James. These are things that go on behind the scenes that we can hopefully add value to in your situation that doesn't necessarily flow down to that overall performance report, but it is ultimately creating more wealth through the form of a reduction in tax liability. So some items that we always take a look at for clients are things like capital loss harvesting. So if we've had a rough patch in the market, which October was quite rocky, there were certain situations where we said, you know what, this particular mutual fund that we own and we still feel very strongly about, we think we should own it in client accounts. It's had a rough patch. Things don't constantly go up. So ultimately we will see some volatility, and that's certainly what we saw last month. There were certain situations where there was a loss in certain positions. So we intentionally sell that position so that way you can write that loss off on your taxes, and then we go and buy that fund back 31 days later because we're still confident in that particular position. But now you were able to reset the cost basis and write that loss off to help reduce your overall taxable income for the year. Some other strategies are gain harvesting. If you're in the 12% marginal tax bracket and you realize long-term capital gains in a after-tax brokerage account, you do not owe any federal tax. So those are things that we take a look at for clients to ensure that given your situation, we're making the most out of the gains that we can take a look at. And oftentimes it makes sense to realize those gains and not pay any federal tax. Now, depending on what state you live in, you could be subject to some minor state taxes, but this is a strategy that we take a look at, especially for clients in those gap years who might not have Social Security started and they're not subject to RMDs quite yet. And finally, asset location strategies. This is a huge part of the way that our investment team manages portfolios. We have a dedicated investment department that works tirelessly to ensure your portfolios are managed each and every day, and they are the most optimized, tax-efficient portfolios as possible. So taking a look to see which mutual funds or bonds aren't so tax efficient, and putting those in IRAs because those are tax deferred. You don't get a 1099 each and every year like you would with an after-tax brokerage account to report that income. Now, it doesn't mean that you own all stocks or all bonds in one type of tax treatment of accounts, but there's a balancing act, and there's a true science when it comes to this that we certainly spend a whole lot of time on and evaluate for client portfolios to ensure, as I mentioned, that you're as tax efficient as possible, because as the chart indicates, these things will whittle away at your return if you're not cognizant of them. So Josh, why don't you talk to us a little bit about some gifting ideas? I know we're quickly approaching the holiday season. Great time for families to get together and talk through some of these things. Maybe you can touch on some of the strategies that we have found very popular for folks to consider taking advantage of.
Yeah, so like Nick said, with the holidays coming up and family members coming to town, I think we'd be remiss if we didn't mention some effective ways to gift. And the first thing to keep in mind, as shown up there, is the annual gift tax exclusion. So in a nutshell, to simplify it, you could gift up to $15,000 as a single person and not worry about paying any taxes on the gift or filing a gift tax return of any kind, just as a general statement. So some cool ways that we like to, and I know Nick especially, a planning opportunity that he loves to recommend is funding or matching Roth IRA contributions to children. Of course, assuming they have earned income. I think it's safe to say that pensions are going to become even rarer and rarer as time goes on. So it's never too early to start saving for retirement, especially for your children. So this is a fun way to do it. Maybe the child puts $2,000 into their Roth IRA and you want to match that contribution as well. What a great way to gift and then help them save for retirement. Absolutely. That's something that we really like to recommend. Another thing that people talk to us a lot about is, how do I pay for college for my kid or for my grandkid in the most efficient manner? Well, we love 529 plans. They offer a ton of flexibility. I know a lot of people have the question, well, what if I use a Michigan plan, do I have to go to school in Michigan? And no, you don't. You can go to school anywhere. However, it's important to know if you're using that Michigan plan, you are eligible to get a small state tax deduction. However, there are no federal tax deductions with 529 plans, so only state by state. But I wouldn't say that it's a big enough state tax deduction where you have to use that Michigan plan. It's still worth a conversation with your advisor to decide which 529 plan is right for you. So essentially how these work, and one thing that is cool about these is you maintain control in these accounts. You maintain control of the investments, and you get to pick basically how these are invested. Dollars will grow tax deferred, just like an IRA. And actually, a lot of people call these 529 plans educational IRAs, which is a cool way to look at it. And distributions can be tax-free, just like Roth IRAs, as long as you use them for qualified educational expenses. And what's cool about the new tax law is it actually expanded this rule and what is a qualified educational expense. You can use these in Michigan now and in many other states as well. For private school expenses for grades K through 12 up to $10,000. So $10,000 a year of those expenses can be used from 529 plans and essentially just distributed tax-free.
For private schools, and I know some of the local private schools in our area, certainly many of them have the tuition bill of a university, so that will certainly help many folks out.
Absolutely, yeah. It was a nice little change from year to year. Well, that's all we have for you guys today. I want to thank everyone again for taking the time out of your day to join us on our annual year-end planning webinar. And as always, if you have any questions at all, please reach out to either Nick or myself. I also encourage you, I know Nick touched on it, to check out our website. We have some great resources on there, including a year-end planning opportunities guide. So one more time, thank you guys so much, and I hope you have a great day.
Thanks so much, everyone. Have a great holiday season, and we thank you once again for your continued partnership and trust, and hope you have a wonderful, wonderful day. Take care.